Good morning, ladies and gentlemen. Welcome to our annual results for 2017. Just to take you through the proceedings, we're going to have Tom Mundy from JLL walk us through the countries of operation at the moment. We're going to have Bronwyn Corbett, our CEO and co-founder, and then we're going to have Leon van der Mertel, our CFO, take us through the results. For those of you who don't know me, I'm Greg Pearson, co-founder of Grit, and what we're going to do is go through what's happened this year in Africa. For us, Africa has provided to give us good results this year, as you'll see in our numbers. And on that note, we're going to go through a presentation of the assets that we have purchased during the course of this year, for those of you that haven't been to any of our visits in the various countries. So thank you very much once again for attending, and over to the video. Thank you.
Delta started with an ambition to change investors' perceptions of Africa through a unique approach to structured real estate. We persisted and pushed through even when we were told our ambition was too big, that Africa was too complex, that it couldn't be done. We achieved what no one thought was possible. We have succeeded because of our people. We believe in the collective impact of the team, the tenacity of the individual. Our team is driven by guts, resilience, and initiative. Because we are so invested, we commit to long-term partnerships with our tenants and collaborate with all stakeholders towards the best possible solutions. We have succeeded because in a world of dynamic complexity, we strive for simplicity. Grit. Grit describes our determination to open doors where they are shut, and our desire to relentlessly push the boundaries of conventional real estate investments, never accepting no for an answer. Grit is not just another acquisition or deal. Grit creates lasting value for our investors, our people, our partners, and the communities in which we operate. Our guts give us courage. Our resilience makes us strong. Our initiative drives our action. Our tenacity pushes us forward. We are Grit.
Okay, thanks very much for the introduction. Just as a bit of background for Jones Lang LaSalle or JLL, we're a big global real estate advisory firm. We've got 250 offices globally. We have offices in Africa, in Morocco, Egypt, Nigeria, Kenya, And in Johannesburg, we've got over 150 people here in Johannesburg. I am head of the strategy and research component for Africa. So I'd like to thank Mara Grit for inviting me here to just give a brief overview, very brief, 10-minute overview of some of the context and the countries in which the company have assets. So I thought I'd just run through a few slides. I start through every presentation that I do just setting the context, the context for real estate in terms of direct real estate investment in Europe, Middle East, and Africa. And at JLL, we track cycles very closely. And we look at every single real estate deal that happens globally. We break it down by continent. This is EMEA. And this is quarters in EMEA, and this is direct real estate investment. So all I'm trying to do here is just show where we are in the cycle. If we go back to 2007, run it through to today, you can see when there's down periods and up periods, where there's a red period, there's a year-on-year decline in investment volume. So you've got the global financial crisis, the Eurozone crisis. And then towards the right-hand side, as you look at it, you can see that there was a sort of jittery period running through from the beginning of 2016 when investors were worried about pricing, particularly in Europe, and they're worried about whether or not it reached the peak and the end of the market. And in fact, if you look at real estate activity in Europe, before I switch on to Africa, in fact, what we're seeing is investors coming back to the market, Chinese in particular. Yields are still coming down, prices are still pretty aggressive. And when we thought market might come off a little bit, it started to pick up. So we'd say we're now seeing in Europe a mid-cycle rotation rather than a peak. Now, why is that relevant for Africa? Because not a lot of capital from South Africa, as you're aware, goes into sub-Saharan Africa, but an awful lot of it goes into Europe, including Central Europe. Now, it's interesting why that's the case, because if you look at the GDP, it's a very, very straightforward chart. If you look at the GDP breakdown of the countries in which GRIT operate in, and then you look at Central and Eastern Europe, and then you look at South Africa, there's some quite clear stories to be told. What I've done here is I've taken the past 5 years of economic growth. In the grey bar, the red bar is 2017 GDP growth, and then the black bar is the forecast 5-year growth. So you can see that in markets and countries where there's been a very, very strong commodity-related cycle, such as Mozambique and Zambia, very aggressive 5-year growth forecast, very much coming out of the cycle after a very tough 2016. Kenya, similar story. It's a little bit more of a balanced market. Morocco and Mauritius, growth just coming off a lid, but still very, very robust in an EM context. Certainly pretty aggressive. If you go to the right-hand side, Central and Eastern Europe, it's not to say it's a market that's cooked, but it's at the end of, probably the end of the road, where markets like Mozambique and Zambia are at the beginning of the road. Growth has been very robust, but the output gap is now closing. It's quite difficult to find growth in Central and Eastern Europe, and obviously South Africa. South Africa is South Africa. Now, again, to emphasize the cycle and the way that GRIT are positioned in that cycle, I've looked at the credit ratings across the countries that GRIT are invested in. I've also taken out Serbia as a proxy for, it's actually Southeastern Europe, but we call it Central and Eastern Europe for the sake of ease. What we do here is we take Moody's, Fitch, and the S&P, we aggregate it, and we create an index from 1 to 20. It's quite a neat way of looking at the way that credit ratings evolve over time. And again, with the GRIT portfolio, you can see something quite clear, which is those markets that are coming out of, which have been heavily commodity reliant, have had a tough 2015, 2016 as commodity prices fell, are coming out of a difficult time. So Mozambique, obviously in structural default. Zambia, copper prices coming off heavily. Struggles in terms of their relationship with the IMF, that is improving. Kenya, pretty consistent. And then the investment-grade countries, Morocco and Mauritius, and South Africa, probably still a little bit of pain to come over the next couple of years. I put Serbia in just in context in the Central and Eastern Europe story because we're obviously in South Africa and it's important. Serbia is not investment-grade. Mauritius and Morocco are. Now, if we look across that portfolio again, you can see why that cycle is so clear. What I've done here is just taken out the composition of goods and services, so look at within the exports, so you can just see how the exports stack up. And that makes sense when you look at the credit rating downgrades and recovery. So if you go from Zambia, where you've got 70% of exports are in copper, to Mozambique, Obviously, heavily reliant on exports, and actually will become more heavily reliant on exports as LNG kick in. And then moving to the right-hand side, much more balanced markets. And a lot of those markets, and I'd say particularly Morocco, have had a really, really strong run, with a lot of support from the IMF, at balancing some of the strong export reliance that they've had, particularly in the area of agriculture. So a lot more balanced as you go to the right-hand side, and that's reflected in where they are in the cycle. Now, if you look at some of the drivers, typical drivers, we look at real estate, especially when you've got heavy retail exposure, but not just necessarily retail, it also feeds through to the other real estate sectors. What I've done here is looked at average household incomes across the GRIT markets. Again, it tells a similar sort of story. What we've been doing with the previous slides is looking at where we are in the cycle, but actually sometimes it's useful to look through the cycle, since real estate we try to hold through cycles. If you take the growth in household income from taken 2005 to 2020, so we get that full sort of range through the cycle, you can see countries like Zambia, Kenya, Mozambique, very significant growth in household income. Admittedly off a very low base. So the dollar number there is the 2020 forecast. So still, there's not a lot of disposable income, but it's improving. South Africa on the right-hand side, it's not the time to discuss the middle income trap, but the markets that GRIT are in are probably not able to have that discussion yet. And on the right-hand side, one of the fundamental underpinnings for real estate is that inflation is managed, inflation comes under control, so there's a more robust domestic lending market. And you can see that in most of the markets that GRIT are in, like Mozambique and Zambia in particular, inflation is starting to get under control as the currency starts to firm, as commodity prices improve. And on the right-hand side, definitely a bit of a pickup in inflation in Mauritius. Morocco is still very, very structurally low inflation. In the short term to mid-term, here are some of the drivers in those markets. Now, again, one of the things the point I'm trying to make about the GRIT portfolio is that it is quite balanced. There's lots of different drivers. It's not a homogenous African story. Every market is actually very different, and mixed between external and domestic drivers. So on the left-hand side, Mauritius, obviously it's a small country, but it is very reliant on EU growth, and it's the same with Morocco. So two of the big surprises, I think, this year, and if we go back to the very first chart I showed you, why has EMEA real estate really outperformed, is because Europe has outperformed. We saw 2.2% annualized growth in the second quarter, outstripping expectations. And that really feeds through into markets where you've got a strong tourism input, or in Morocco, where you're exporting auto parts or aeronautical parts. Morocco, again, since we're on Morocco, very strong agriculture. It's 40% of the labour forces in Morocco is employed in agriculture. Now that's in an environment where you've got low inflation, that means you've got very strong private sector consumption. So that's growing this year at about 4.5%, which is double the previous year. If you look at slightly more, I'd say it's a controversial market like Kenya, particularly with the politics, I think it has been a major headwind in the commercial real estate sector, certainly if you look at rents and if you look at pricing and deal flow this year. I'm not going to talk about Kenyan politics, but it's potentially a constitutional stalemate, at least through to the end of this year, and I think it is more of a challenge than we thought it might be a month ago. Zambia and Mozambique are actually two very interesting stories. Zambia, IMF is starting to come back to the table. They're looking for that $1.5 billion sort of plug for their big fiscal deficit. They're getting their spending under control. Copper prices have improved. We've gone up from about $2 a pound to about just shy of $3, so we've had a sort of move again out of the cycle, which is a big driver. Agriculture, record harvest in the first half of this year after a late rain. So again, upgrades GDP expectations in Zambia for this year. And Mozambique is an interesting story, and again, in a country that's in structural default. If you look at countries that have outperformed after default, go to Russia 10 years after the default in 1998, they tend to do very well, particularly in Mozambique when you've got a driver like LNG. So look at the ENI project, the offshore project that's worth about $10 billion of investment. That'll feed through into logistics, into warehousing, and into the broader economy. Probably the current account deficit will widen in the short term, but significant, actually probably mid to long-term drivers. South Africa is South Africa, but it's really a domestic story at this stage, unfortunately. And then just a couple of slides just to finish off, because I need to get on to the meat of the presentation. There are risks. I'm quite bullish about this mix of countries, but there are obvious, significant, important risks. One major one in the context of the unwinding of QE, and we just go back to the Fed announcement last week, and we should expect a hike in December. We should probably expect a hike in the at least 2 hikes next year from the Fed, is that we're going to see a stronger dollar, and that's going to be very risky for countries that took on a lot of external debt. And it's across almost all of these countries, with the exception of Morocco, is that there is a really significant rise in either gross government debt or external debt. Interest payments are going to get a lot more expensive soon. And my final sort of food for thought is, I think, again, these are not homogenous countries, but there is an underlying story of issues about liquidity. And where I see a potential driver in the future is in the REIT market. I think it's worth mentioning. The one way to look at the REIT market is to see the liquidity that REITs provide. So one way to do that is to look at the way that pension funds are allocated to real estate and to other instruments. So very, very straightforward. I've taken pension fund allocation to, so we've got fixed income, equity, and alternatives. So I've taken here fixed income allocation by pension funds in South Africa, Nigeria, and Kenya, and the OECD average. And there's a very clear story here. Generally speaking, OECD average allocations to fixed income instruments are falling, so developed markets falling. But in emerging frontier markets like Nigeria and Kenya, it's really increasing. Nigeria, for example, has a massive allocation to fixed income. Kenya, it's increasing. Now, why is that the case? It's because there's not enough product in these markets. It's very difficult to add that liquidity into real estate. So if you look on the right-hand side, look at the alternative, the allocation to alternatives. OECD average, it is pushing up, but and actually in South Africa too, because there's so much pension fund liquidity. But markets like Nigeria and Kenya, it's falling. So why? As I said, because there's no product. But actually, if you look at markets like Kenya, there's 19% of all pension fund AUM goes into direct real estate, which is the highest in the world. It's an extraordinary amount. But zero goes into REITs. So if we want for sort of a positive story for the future and something to keep an eye on, is look at legislation in these markets. I would put Morocco in this basket too, and I would say Kenya as well, where there's legislation to bring that liquidity and that domestic liquidity into these REIT markets. And if we were to do that in Kenya, reallocate from that 19%, take 10% and put it in REITs, it would be about $800 million of liquidity would go into the real estate market. Now, it's huge when we talk about the volumes that we see overall in Africa and sub-Saharan Africa annually. It's about $150 million. So there's potentially a huge source of liquidity. If anyone wants to see this presentation, I've just made some notes at the end. So if the great guys want to send it out, I'm very happy to have a discussion later. And that's it.
Thank you, Tom. I think the rationale behind having JLL have a presentation this morning, and hopefully you found it informative, is that as a management team and as an executive, we've been previously criticized for being very counterparty focused and not necessarily country focused. So, it was quite important to demonstrate that when we go into these target countries, we do assess them and we do have certain gatekeepers. And counterparty is one of those mitigants into these countries. So, and we've seen the rationalizations of that through Mozambique. And we've got a slide on Mozambique. We call Mozambique our country of grit. And it's not to be funny, but the reality is that we have gone from a macro perspective in Mozambique through some of the most challenging times. And we sit with a real estate portfolio that has been mostly unaffected by SAME. So we have to ask ourselves the question why. And the question why is that the fact that some tenants in Africa they obviously affected by macro, but they do not exit the continent when there's a macro crisis. So we've seen tenants, Anadarko's, the Vodacoms, the Hollards, the KPMGs, and I said I wouldn't mention KPMG today, but those particular tenants, we have no vacancies, we have very minimal arrears that sit out of Mozambique because they've continued business as usual. So from our side, we're very happy to release our results. We've had an interesting and extremely busy 12 months. I think our intention was to look at the ability to bulk up our portfolio. One, because of the fact that we don't have many competitors in the market, and that is a very unique position to be in. which allows us to buy quality A-grade tenants at relatively inexpensive yield. So for a Imperial, which is one of our assets that's just transferred post-year-end. Imperial Distribution Centre is a very good example of our investment strategy. We have the ability to have a sale and lease back, 10-year lease. Imperial South Africa actually signed a guarantee, which takes away the Kenyan risk. We had a financier that's in the room today giving us very favorable dollar funding on that. So you're buying at 8% property yield, you're funding under 5%, you're still getting your annual escalation at 3%. So the return is still excellent. It's actually beyond, I believe, the return that some of our competitors are seeing out of Eastern Europe. And thank you, Tom. I don't know what happened over here. Thank you, Tom, for bringing up Eastern Europe, because I think that's unfortunately where we have risk, where the capital is lost. So why are you aren't investing in hard currency Africa? Because the money is going into Eastern Europe. So it's important to understand what our investment strategy is towards in comparison to Eastern Europe. So some very, very big events happened this year for us. One, we closed a successful capital raise to the tune of $156 million. That was undergone through a rights issuance as well as an additional capital raise. I can tell you $156 million for Africa is very difficult. We've had to spend a long, long time on the road from one end of the world to the other, really educating the market, one around real estate, because our product offering is so unique from a frontier perspective. The other aspect is Africa. So I think we have a tendency as South Africans in the investor market out there to taint Africa with one brush. So I think a lot of our competitors have been heavily hit in West Africa and have said we're exiting Africa because, it's not the place to be. But our investment strategy, again, which I drive home, is that we want a soft sort of criteria that we don't want to be more than 25% exposed to one market. Yes, logistically it becomes a nightmare. Yes, you have to have an army to manage it. But what it does is that it gives you a nice diversification. We've been successful in having the diversification between the northern part of the continent, the eastern and the SADC, and now we look to the western part of the continent. What's also important is that we look beyond the commodity drivers, because the commodity drivers is what's had an impact specifically on West Africa. So you'll see places like Morocco, where people thought we were mad to go into. You can see the fundamentals of why that country makes sense from an investment perspective. We've obviously achieved and paid out our 7th distribution, which finance is obviously very proud of. We've still seen just under 3% growth in our distribution, even though we did a discounted rights offer, which I think is quite significant. One of the most things that we are proud of, which differentiates us from even our South African competitors, is our WALE. I don't think many companies can boast a weighted average lease expiry period of just under 8 years. And those have seen significant renewals of tenants like Vodacom, KPMG, Barclays. We have secured dollar leases. We haven't had any revert back to local currency, specifically in Mozambique. We've seen no rental revisions. We've seen escalations in those leases. Hence the driver, hence the forecast out of 3 to 5% distribution growth going into 2018. Another significant aspect of our business is our cost of debt. When we listed Grit Delta Africa at the time, our cost of debt sat in excess of 8%. We've managed to successfully bring that down with hedging out fixing 70% of it, with a combination now of euro and dollar debt. The assets in Mauritius gave us a very, very good entry into the euro market from a borrowings point of view. I have mentioned previously those hospitality transactions, which our board, it was very difficult getting it through our board, because I think as South Africans, again, we suffer from the concern around hospitality in general. But remember, Mauritius is a very unique market. The hospitality is one of the big drivers of the market. So we just chased the real estate where that was a driver of the market. And we were able to buy those assets at a property yield of 8% in euros. We were then able to inject 5-year interest-only fixed money at 3.75, which took the geared return to over 10%. We had a very large pension fund inject a preference share into the Lux transaction. And you'll see a particular slide on Lux, which took our overall return to investors on Lux to 15% in euros. And that is quite significant. And there's a lot more that we're going to be looking at to drive that overall yield and overall growth from a fund perspective. On the occupancy side, this is a very important number. We are mostly occupied, 100% occupied across our entire portfolio, except for Morocco. Morocco has also been and it's not Morocco as a country, but Anfa has also been our asset of grit. I think the challenge that we faced with that asset is when you buy an asset from a developer and you don't keep them in the asset like we have in some of ours, there's a tendency to fill up a shopping center or fill up an office building and not think about the sustainability of those tenants. A lot of tenants entered in Morocco, a lot of high-end brands with this thought process that Morocco is Europe. Morocco is not Europe, I can promise you. It's still part of the African continent. It might be sophisticated. Casablanca might have the infrastructure, but the consumer market is extremely price sensitive. What does that mean? It means that you have to have brands that recognize that. So we've seen the Turkish brands take Morocco by storm. We've put LC Waikiki into our center in quite a large footprint. They've had exceptional turnover, exceptional trading numbers. So what we've done is that we've shifted out all the high-end brands out of our particular center, hence the occupancy. And what we have done is now we have created a B-grade family shopping experience, which we think suits the market perfectly and has been supported by the asset management of the team. So this is a particular asset that we will hope to put to bed literally in the next couple of months. And then it will roll into a greater structure on OPCI, which is REIT in Morocco. And Tom alluded to the REIT discussion. I think the REIT discussion is a massive opportunity on the continent. And we are the perfectly positioned company to take advantage of REIT legislation. So a lot of these points I've gone through. To note, we now have 20 assets, exposure into 5 countries. We are sitting at an asset value of just under $550 million. A key focus of the team, and you'll see that the team won't chuckle at this point, is to now sweat the portfolio, bed down the assets. We've taken on a significant amount of new assets. It's now the ability to asset manage those assets. Where are there the opportunities? Anfa redevelopment is coming in a very high development profit. Anadarko Phase 2, we actually complete now in October. We did that development as grit. Imperial Phase 2, we will also do that redevelopment at a development profit of approximately 12%. So how do we sweat the portfolio? How do we grow the NAV? Yes, we are dividend focused, but we are not a REIT. So our importance is not just dividend, it's NAV growth as well. We have a target of 12%. And the management is severely penalized on not achieving both. They rank equally in our lives. And our bonuses this year, yes, we did a discounted rights offer. Yes, it was approved by the board, but we were severely penalized for our NAV discount, effectively. So the importance of NAV is critical. The importance of getting back our share price in SA and the JSE back to NAV is critical. The liquidity is critical for us. So those are key aspects that the team is focusing on. We'll be entering the SEM 10 now, which is an index-tracked index in Mauritius. We'll be placing 8s on that. Again, that promotes liquidity. That promotes shareholder interest. We've seen a whole lot of interest for stock in Mauritius based on that placement in the index. We're tracking closely to MSCI Frontier, which is important as well. With the exit of the NEPI Rockcastle consolidation, we've been closely tracked to that particular index, which again will bring in the tracker funds, will bring in the liquidity that we're looking at. So just this slide just basically gives you a picture of where we're located. And I think you have a good indication of our countries, current countries of location. Target countries for us, Botswana, Ghana, and Rwanda. We're working with the Rwandan regulatory authorities, with the finance minister directly on getting REITs promulgated there. We're working with the local pension fund to roll their assets in for shares. So when you hear me that I'm not going to be doing a capital raise for the next 12 months, which I'm not, I can assure you we still have ample opportunity to grow our market cap. We've got some very good pension funds, very large pension funds, as Tom alluded to, that sit on large real estate portfolios. We've got these pension funds that will roll their assets in for shares. So Rwanda is a key target country for us. Ghana is another country that we are targeting. Why Ghana? We looked at it 4 years ago. We found it completely overpriced from a real estate perspective. We've seen property yields shift out by 2.5%. That is significant with valuation. So Ghana for us is now very much perfectly priced for an entry for completed assets. Assets that fit into our counterparty. And I asked somebody in Mauritius to count how many times I say counterparty, but I'll probably say it a few times. Counterparty, it fits perfectly into the ability to secure very, very good debt, the ability to secure tenants with a long WALE, weighted average lease expiry. So those are all our key areas. One of our analysts in the house called it my gatekeeper's margins of safety. So I'm not sure which one I prefer. But I alluded to the margins of safety. What do we look at when we look at a country? And we've got one of our IC board members here. If we don't achieve any of these, even if one falls short, we will not invest into a country. We collect 90% of our income in dollars and euros. Why do we not have an issue in Mozambique? We collect in dollars. We move it from a Vostro account into Mauritius. A lot of people that have had challenges in Mozambique currently in the last 12 months are trying to convert METs that they hold into dollars. That is not our model. What else do we have in place? We have political risk insurance. What does that mean? PRI. It means that we can secure dollar liquidity and expropriation of funds. We have it in both Morocco and Mozambique, which means that our debt providers have that assurance that we have the ability to service the debt, which means that our competitors or some of our partners are looking at debt, dollar debt in Mozambique at 10%. We're securing it at 5.5%. So that, for me, is one of our key selling points. So those margins of safety, if one is not achieved, we won't invest in a particular country. Be careful not to taint Africa with one brush. That's all I'm saying. You know, it has a tendency to say Africa is a very deep, dark place. The reality is some of these markets, as Tom demonstrated, have even more growth and have significantly more growth than even the markets we sit in today, South Africa. What else is there? You know, the fact of the matter is we have a WALE, as I mentioned. We can forecast our distribution growth. We know where it's coming from. A lot of the funds in South Africa have forecast negative distribution growth. Real estate is extremely oversaturated here. So if you've got a management team that understands the risks of Africa and how to mitigate those risks, it's important that you do look at these markets. That's where the growth is coming. The only frontier is Africa. Look where the population growth is coming from. It's all coming from the markets in Africa. It's not coming out of any other frontier markets. So our shareholder base has been very, very important. You know, the PRC has backed us as the Africa real estate story. They have become a very significant shareholder in our business. They have also, you'll see that I will mention Gateway Delta, which is a development vehicle that we have invested in. They've also significantly capitalized that company. Gateway Delta has raised $185 million for developments. We are a key investor into that. What does that mean? It means we don't take development risk per se, but we still get that IRR, which is sitting at a minimum hurdle rate in Gateway Delta of 20%. So we're still getting that NAV kicker, even though we're not fully exposed to development risk. So you'll see that Delta Property Fund is obviously, they never followed their rights. We see them becoming smaller and smaller over time. Drive-in trading is the transformation deal that we've previously concluded. A very exciting transformation deal because not only is it important for our biggest shareholder, PRC, but also important for one of our other shareholders, Eskom, but also important for the DFIs. The IFCs, the CDCs, the EBRDs, all of those DFIs want to see your company doing transformation. This is not a South African unique thing. So that's why it was so important for us to put together a very strong transformation deal for these companies, because the DFIs have long-term capital for Africa. They're not going anywhere. And it's important that we are able to get the DFIs in as equity holders as well as debt providers going forward. And we work very, very closely with them currently. Just to note, management, I sound like a stuck record. I say this every single year. We bought in on day one. We got no free carry. My standing joke is that my children, my cats and dogs are literally locked up in the vault at Grindrod because we are highly geared on those shares. So we are as closely aligned to our shareholder base. I had somebody said the other day, we just need to think about our shareholders. And I said, please remember that we are a shareholder. We don't have an external management company. We're not incentivized through external management fees. We're incentivized by driving this particular business, driving the liquidity, driving the stock price. We are completely aligned with our shareholders. This gives you a very good picture around what our diversification. You always hear me say that we will look across any asset class, and I will continue to say that. What does that mean? It means that we want the strengths of a GE, an Anadarko, a Halliburton, an ExxonMobil. We want to be able to provide them a real estate solution. And often it comes in different forms. It might be offices. It might be DC centers. It might be corporate accommodation. So that is absolutely key that we don't get fixated on retail, commercial. The diversification across our portfolio has also seen a lot of our success. we see a lot more coming out of the distribution side, specifically around Kenya. Again, retail terrifies us in Kenya. Anfa, for me, is one of those assets that has taken up so much management time. Convenient shopping for Africa, for us, is the only way. We've got 7 shopping centers. They all trade exceptionally well where they sit on convenience. They're not hit by macros. They have no luxury products that sit in those particular centers. So for us, convenience retail is definitely a key focus. This gives you a good indication. I've gone through most of these points. I just want to note that you'll pick up that our escalations. So we are still able to secure very, very good annual escalations, and all of our renewals have been able to achieve those escalations. So if you remember some of my previous talks, I've always said when we enter an asset, it's not only about the value of the asset, but what is the rental sitting at? Is it over-rented? Because the worst thing that can happen is when you renew the lease, you have a 20% rental revision. And we've seen that in the SA market. So I must be careful what I say about my IC. So my IC is completely and utterly focused when they look at a transaction. Go and test it to market. Test that rental level to market. Are you over-rented? Because that has a massive impact on the valuation going down the line. I've discussed most of this, so you can have a look at this particular slide. It's just diversification between country as well as a diversification between asset class. The growth, again, I say we are going to track the distribution, the industrial side of Africa. We're working with some big corporates at the moment. We're working on some big corporates that are also going to do sale and leasebacks that are sitting on some tremendous portfolios. So you'll see that sort of the next sort of set of numbers, you'll see that DC, that distribution, industrial side really coming out strong from an asset class perspective. I think this is my last slide, and it's ironic that it finishes on counterparty. So I think this slide just depicts where we are focused. So you'll see a majority of our portfolio is exposed to A-grade tenants. The B-grade tenants, again, are just still your national tenants. They're just not as large as your A-grades, the Carrefours, the ShopRites, the Choppies, all sitting at that level. But for us, we will not deter from this strategy. We see lots of opportunities, I can assure you. Being one of the only players, we see lots of assets coming across our table. But if we cannot satisfy ourselves about the counterparty strength, are we able to get a corporate guarantee? The Lux transaction was done on a head office structure, RBL corporate guarantee. That's very important for us. So it then takes away, even when you fund it, a lot of the risk, which makes sure that your funding rates come out even more preferable. Good. Leon, can I ask you to take us through the numbers? Thank you.
Thanks, Bronwyn. I think we're all here just to really understand the numbers in a little bit more detail. So I'll take you through as best I can. If you've got any detailed questions, we can take them afterwards or individually one by one after. So just starting with the balance sheet, I think the one thing that's clear here is the growth. We've had exceptional growth during this financial year, and this is going to continue into the future with the deals that Bronwyn has mentioned. I think there's obviously one negative that we need to take care of, and that is really the NAV per share. You'll see that we had a drop of 7.6%, but I'll unpack that a little bit later. But key to it as well, loan to value, we're sitting at 41.6% at the moment. This will normalize around about 48 once the impact of the acquisitions that came through just after year-end come through, and we utilize a lot of the cash. I think the one item there is going to strike out there is your current assets. Of that 51 million, just under half is actually in cash. And then there's a fairly big VAT asset. As you know, when we buy some of these assets in the economies that we operate in, we have to actually have a VAT component to these acquisitions. In terms of the debt, the current liabilities sits quite high at 69 million. But the bulk of that, just under 50 million, is actually the current portion of long-term debt, of which most has already been refinanced. I've got a slide that we can unpack that a little bit more. Just in terms of our total asset value, this is where you really see the growth. In 2015, when we started, we had $130 million of assets. Then to 210, 295, 492, and now, as we sit at the 31st of October, 546. This is going to go up to about the 600 mark once the Imperial Phase 2 comes online. And the darker Phase 2, we've got very nice revaluation profits that's going to come through there, as well as our investment into Gateway Delta. Just to try and unpack this NAV, it's easy to say you've got a 7.6% drop, but I think we need to understand this in a little bit more detail. I think key for us is the difference between last year and this year. We did a distribution just before the rights issue, 4.57 cents. That's quite a key difference in understanding the drop for the entire year. If you look at this slide here, we're trying to do a like-for-like comparison. So if we take our NAV at the end of the year, net of the dividend for that financial period, we were at $1.57 for last financial year. On the same basis, we're at 149 this year. So you'll see that that's actually a 5.5% decline in the NAV per share. But then we unpack that a little bit further. The impact of the rights issue, you can see there. That was 11 cents drop in NAV. But this is on the back of buying a number of assets which are highly yield accretive to us. But the real reason that we need to unpack this and understand this is what's happening from the operations, what's happening with the assets as they're increasing. And you'll see there that there's 2.2% growth that's come through our asset portfolio, through the revaluation of assets. This is quite key for what's going to happen in the future, especially when we look at the Mozambique portfolio. The macros are obviously going to impact things like discount rates and et cetera for the DCF valuations. So once the lights turn on in Mozambique, which is going to be sparred by the natural gas project, I mean, the $10 billion inflow from ENI is quite key. And that's going to change the macroeconomic environment in Mozambique especially. Then we should see a very good increase in those NAV revaluations. I think the one thing that's shone through this whole financial period was the rights issue. We raised $121 million. This was no mean feat. I think we saw close on 400 investors, a lot of them private individuals, to try and get the liquidity back in the stock, trying to move away from just having corporate investors and having a lot more free float. We've seen the benefits of this, especially of late, and especially in the Mauritian market. Our trading liquidity, there's a slide on it later, you'll see it's improved remarkably since the rights issue. The one thing is raising the capital. Obviously, the next thing is deploying the capital. We don't want to have a huge cash drag on our balance sheet, and we were successfully able to deploy $110 million up to now. There's still a $3.2 million payment which we need to make once the final 40 rooms on the La Victoria Hotel are completed. And then we're expecting some investment calls for capital from the investment in Gateway Delta. In terms of debt is obviously a very important part of our business. We want to always gear our assets around about the 50% mark, sometimes higher, sometimes lower per asset, but never more than 50% in the long term. So in terms of the debt exposure, the key thing is what's happened to our cost of debt. Significant decrease from 6.2 to 5.8. But this is on the backdrop of LIBOR increasing by 0.45% over the same period. This has been achieved by the fixed interest rate contracts that we have in place on a number of our loans, but also the move to take a lot more euro-based debt. On the properties, we generally we match the currencies of the actual investment to the currency of the debt. You'll see the euros as stayed at 30%. But on a fund level, where we need to try and protect ourselves from any movements between the euro and the dollar, which is going to become key for us, we're going to be taking a lot more fund level debt in euros rather than in dollars. And this will protect us from any NAV revaluations for the movement between the dollar and the euro. Our debt expiry, as I alluded to earlier, there's a large portion of debt that comes due this year. Just after year end, we actually had the Cosmopolitan Mall, the debt paid out on the 7th of July. We took ownership of that structure on the 28th of June. So that was paid out just after year end. In terms of the facilities, in December we've got two facilities that become due. The first is our short-term loan that we took from State Bank of Mauritius to help finance the BHI transaction. That has now been refinanced on a 3-year term in euros. The construction loan that we have currently in place for the Anadarko Phase 2, once that project is now finished in October, November, we're going to convert that to just a normal commercial debt. And then the revolver facility, as I alluded to, this figure here actually comes due in June. We've refinanced that now in September, and that's now in euros. A big thing that we're going to be focusing on in the next 12 months is obviously we have quite a big debt portion that comes due for our Mozambique portfolio. We're going to be doing a total portfolio refinance, and we're going to be looking to dropping our cost of funding on that, which currently is at 5.4% margin. The last debt we did in Mozambique was at 5.1%. So just in terms of the financiers, obviously our debt partners are very important to us. You'll see the introduction of Bank of China this year. They are now our biggest funder, and they've actually increased post-year end to $77 million. This is quite a key relationship for us because Bank of China shares the same risk appetite as we do for Africa. They understand Africa and they're not scared of Africa, which is quite key. Investec continues to be a big funder. State Bank of Mauritius is one of the new funders that have come in, especially on the BHI and the Tamassa transaction. This is euro-based debt. Standard Bank South Africa remains a key component to our debt profile. And our biggest backer in Mauritius right from the get-go being Afrasia. They're maintaining the standard, 19 million. And that we're seeing to try and push that up during this financial year. And now while we're all here, distribution. So when we look at the total unpacking of the numbers of how we got to our distribution, you'll see that rental income increased 17% from last year. This is basically in line with the escalations that we did see on the lease. I've got a slide just now that shows how that will move into the future. But this was also as a result of some of the new acquisitions we took in March, which was the Tamassa transaction, as well as Malta Tet. The biggest increase that we're seeing there is our income from associates. So this is purely the full year impact that we had when we bought the Makuba and the Kafubu Mall. They came through in December 2015. Now it's a full year impact of that coming through. Operating expenses, this is increased in line with the increase in the properties, with one exception, is we had to do a fairly significant debt provision. One of the tenants in our Barclays house building has been put into liquidation by us. And that accounts for about $300,000 that we had to write off at this time. So it's not all rosy, but it's manageable. In terms of admin expenses, you'll see there we've gone from 3.9 million to 5.6. This has to be unpacked in the fact that this is actually, in terms of the value of the properties, has gone from 1.3% of the value of the properties to 1.1. And we see that declining further as well. Interest income, this is quite an interesting one because when we did our initial investment into BHI, it actually was in the form of a convertible loan. We had quite a period of time to get the regulatory approvals to actually take transfer of the properties. So we made that investment and we actually earned interest income during that period. Interest expense, this is really just in line with the increase in debt in combination of the decrease in the cost of funding. And then our realized exchange gain. So in Mozambique, we have an exceptionally strong dollar position. We've seen quite a big movement in the Mets over the year. It topped out around about December at about 78 Mets to a dollar. Since then, it's come back to about 60 and has now stabilized. So where we were able to actually get quite a lot of windfall profits out of just delaying payments to the last day before we actually sold the dollars to Mets, we were making very significant gains there. That opportunity is now slowed down. We will watch that very carefully into the future, but luckily, we don't face any downside risk. If there is a currency movement in the opposite direction, we just sell the dollars earlier and actually make those payments without any risk. Tax, we continue to manage our tax very, very carefully. We've got significant tax allowances. We've just got a new tax incentive for the Mozambique portfolio. So we're looking at, in combination with the high property allowances we get, as well as the effective use of debt, we've got about a 3 to 5 year period where tax is not going to create a significant leakage. Beyond that, Bron is going to talk about the REITs, which is going to be very good for us in terms of managing our tax in the long term. So just in terms of distribution, I mean, this is quite key. 2.7% increase in distribution. It's slightly down from the 4.1% increase that we had. This is largely to do with the Anfa asset, where we've had to put in some vacancies to start moving these tenants around and start getting the right tenants in place. I think it peaked at about 20% vacancies, of which 16% is directly related to the actual project. 4% sits as just the vacancies through the centre, especially in the street retail that sits outside of the centre. So what is happening to our income? This is quite key to understand. So if we look at our total assets, excluding Anfa, just so we can try and understand it, our existing asset base has increased 4.5%, which is in line with our normal escalations. In terms of Anfa, it decreased 1.1%, which is as a result of these vacancies. But then we look at the new assets that came on. The assets that transferred before year end is going to add about 29% to our rental income. And the assets that we took transferred just post-year end is going to add another 30% to our rental income. Obviously, we've got to look at what is the quality of our income and how long is it going to last. We've often been said, oh, you're only increasing your WALE by making new acquisitions. That is 100% true. But thanks to Heidi's team's efforts of looking at the current portfolio, we've got significant increases in our WALE as well. If you look at last year, 5.8, on the same asset base, which is the assets we're existing, we're now at 6.1 12 months later. This is as a result of the successful negotiations that we've had with Vodacom. They've signed a 10-year renewal on their lease. KPMG, same story. Barclays was a 5-year increase. We've just signed in our Zimpeto Square a 10-year renewal, well, a new tenant that came in there, Sunai, Portuguese retailer, that's a 10-year lease. So we've made significant increases in our WALE and the security of that income going into the future. I think then we look at what's happened with the assets that transferred during the course of the year. Obviously, we had Tamassa that had a 10-year lease, Muldetet, which was on average about a 5-year lease. So that increased our WALE from 6.1. Those specific assets were 7.1 years, took our average to 6.4. If we're looking at that now, after the assets that transferred post-year end, we've got the BHI transaction, which is 15-year leases. We've got Imperial, which is a 10-year lease. So you'll see that increase is now a very healthy 7.8. Just in terms of our admin costs, as I alluded to earlier, it has increased quite a bit. Obviously, we have to manage these assets. We take a very strong approach of actually being on the coalface, being with the assets, making sure that we understand what's happening on the ground. But this obviously takes a very big team. It obviously takes quite a bit of travel, and it actually puts quite a bit of pressure on the family life of our staff. So it's very key for us to make sure that we've got staff that are in place, that are happy, and that have a shared passion for Africa as we do. You'll see that in terms of the asset base, it has come down as a percentage, and that will continue through the next financial year. Back to Bronwyn.
I won't keep you too much longer. I've gone through quite a bit of this already, but just to reiterate some of these, I'm going back to the finance section here, to reiterate some of these points. So I mentioned the slide earlier, Mozambique, our country in grit, and why do we say that? So if you look at the analysis, we look at sort of the key challenges that have been faced from a macro which has now impacted our portfolio. So you'll see that amidst all of the challenges that Leon clearly mentioned, some of the asset management initiatives that have been taken place, the new facilities that have been put in place, the maintenance of being able to maintain the yield and the cap rates on the revaluations due to these lease renewals that have been done. So Mozambique gives us a very, very good case study in relation to what happens when macros of a country do turn on a real estate portfolio of our nature. So this is a very, very good slide to demonstrate some of the initiatives that have been done. Morocco, we've mentioned Morocco a number of times, very, very management intensive. All of the sort of challenges that are faced and how these are going to be addressed now. We have huge demand for the centre. We have lists of tenants. It's now to select those which are going to suit and work into the B-grade shopping concept, to sit with a fully occupied shopping centre. To give you an indication, this type of asset, upon completion, should sit at a cap rate of approximately 7.5% to 8% from a market perspective. That's what the market in Morocco is currently driving from a real estate perspective. So that's what we are ensuring, that we complete the redevelopment and we successfully actually take this to be able to roll it into the relevant REIT structure. The Tamassa Resort, one of the exceptional items that we achieved not only was the 15% return on equity, but the other aspect is that we put a variable rent, which we never factored into our numbers. The variable rent is what you understand as turnover rental with retailers. We always said we would not factor that into our numbers, and this year we've only owned the asset since March, and it's actually kicked in, which means that Tamassa, the Lux Hotel, closed at an 89% occupancy rate for the entire year, which means that we had significant upside on this 20% here. So this is something that, obviously that will come into the numbers going forward. Tamassa has just been ranked as the best 4-star hotel on TripAdvisor, and obviously has got huge marketing campaigns to ensure that we then trigger this hopefully again into the next financial year. On a market overview perspective, I'd mentioned that we had done significant work as a management team to now track our liquidity. You have a tendency of frontier market investors that need to invest in frontier, but they can't get liquidity. I think a lot of the guys have been challenged in Nigeria and Zimbabwe specifically. So we need to be able to just demonstrate that our investment, you are able to exit our investment if you need be. So the same chain tracking, the MSCI frontier tracking for us, we actually now have a specialist department. We've become quite sophisticated in looking at these numbers, but it is important because you do then get your tracker funds. Looking ahead, what next for us? So some of you had seen that we had launched a separate vehicle called Paradise Hospitality. Paradise Hospitality was to take advantage of exactly what we did on the Tamassa transaction. The ability to put in a pref share as a B class. This pref share has been listed on the SEM. The pref share at a B class has the ability to kick the A class holders, which is GRIT, significantly up from a return perspective. The challenge we sit as an asset management team is that when you've got a fully occupied or mostly fully occupied portfolio, you've got a WALE of just under 8 years. How do you get that NAV kicker? How do you drive that growth? So it's important to have initiatives of this nature. The other aspect is that we are seeing a whole lot of assets coming into the table on the sale and leaseback perspective. A lot of owner-operated hotelier groups who traditionally sat on their assets are now seeing it as an eloquent way for them to raise capital, equity. So we also don't want to be overexposed to hospitality as GRIT, but we want that super kicker return that we're looking at. So this particular vehicle, we are in the market of sourcing an MD. We've got a board, a hospitality board that will actually run this vehicle, but it will all be housed under the GRIT label. Gateway Delta successfully closed after 18 months. I think why we went this route is that with our presence and our existing assets, we are seeing a huge amount of development opportunity. We don't want to stand in line for the private equity assets necessarily. You have the Actises, you have the R&B Westports. Yes, they've got good assets, but traditionally we have found them hugely overpriced for our particular model. So we want the ability to partner with a developer, have an upside with a developer, but also being in control of our development pipeline. So we have a fully fledged team. We have an MD of this business, Tim Redman, and this team is about 10 people now already. They've partnered with developers. They are rolling out a very, very nice development in Rwanda. They're looking at something in Mauritius. They're looking at the American Embassy housing compound in Ethiopia. So very, very strong tenants, very strong upside at the end. So the intention is you'll see that their IRR hurdle rates are quite high. So they need to be developing at approximately a 12% development profit to be achieving this. What we want then is we want the American Embassy paper, the UN paper, we want that re-rated at the end to the 5-6% because that will give the very, very large NAV upside. And as you can see, GRIT is a 20% shareholder in Gateway Delta. REIT legislation, I've spoken enough about this. It's only the beginning. I think we've seen a REIT in Kenya that hasn't had much success. We believe that there's still a huge amount of opportunity in Kenya. We believe that there are big companies sitting on assets, real estate assets, that you could give them a REIT solution in Kenya. We have the ability to roll our assets into that. So REIT legislation is something that is a team for the next couple of years that we will focus on because it gives us the ability to invest in REIT markets. Leon mentioned the capital allowances and the allowances, which is reducing our tax, but that won't be in place forever. So we need the ability to pull through REIT distribution back into our holdco in Mauritius. And finally, forward guidance. This was always a tricky one because, it's always, have you been too conservative? Have you been too bullish? But we've come out with a distribution growth of 3 to 5%. That's June 2018. We are seeing even more growth the following year because of the Anfa completion. This particular number takes a hugely conservative approach on Anfa. I will be sweating the team to ensure that even better number is achieved. And then a target 12%. we need to get our share price back to NAV, which is sitting at just over $1.50. We're tracking 136 to 140 on the SEM. The exchange rate moves daily in South Africa, Rand dollar. It's about 125 in South Africa. The forward dividend yield in Rand equivalent, we've done a very nice slide, which I haven't shared with you today, but I will share with you at a point in time, which tracks us to some of the South African peers. We are sitting in a Rand equivalent in over 10% dividend yield, with I believe, a much better quality portfolio where you can actually see the growth coming out of. Good. That's me. Thank you. So if we can please take questions. I don't know if the questions from anywhere else, Mornay, if we can just we're just taking from the room.
There will be questions from the webcast potentially as well.
Okay, so we'll just make sure we get those too. So if anybody can open the floor up, I'm sure there's one question. There we go, Ryan, that just had to be you, yeah?
Ryan. Sorry, Ryan, just wait for the mic for the people on the webcast.
Brian, you mentioned KPMG. What is your current exposure to KPMG?
So we've actually only got KPMG in Mozambique. Correct. I'll make sure. And I think, what's been interesting about some of the offices that we've seen, even from the legal perspective, is that even though these offices have an affiliate name, they come actually from legal or accounting practices that have had presence in countries for hundreds of years. And KPMG actually fulfills the same. So we're seeing KPMG in Mozambique quite standalone. And so we're not too concerned actually from a KPMG perspective. But we don't sit with a huge amount of KPMG exposure. But there's not much link to the South African balance sheet, which is quite good. Well, who would have thought Mozambique KPMG would be better than South African KPMG at the moment? But anyway, the irony of the world. Any other questions?
No questions from the webcast either.
Okay, good. Yes.
Are there any other countries that you focus or looking to get exposure to? Maybe 2 or 3 others that you don't have.
Thanks. The 2 other countries which the management team has spent, actually 3, and they are on lesser degrees of importance, and I'll tell you why. The 2 countries we're looking at are Rwanda and Ghana. Rwanda, very small country, but a lot of opportunity. And it comes up the fact that you have a very progressive government. You have the pension fund with a very large mandate to not invest necessarily just in Rwanda, but outside of Rwanda. So you have the ability to partner with the Rwandan pension fund. You also have Rwanda and Kigali itself, the president's done a good job to offer significant tax concessions to build head office structures for East Africa into Rwanda. So we're taking advantage of some of those new builds coming through. Gateway and Delta's going to invest in one of them. So Rwanda for us is a focus country. The other one is Ghana. So we believe that Ghana has seen some of the most difficult times, and we see an upturn in that market. So as I mentioned earlier, assets that were priced historically at 7% property yields, we're now looking at 9% property yields. So that's a significant difference in valuation. So we think that there's a huge amount of opportunity. And also the banks are looking at it favorably. It always helps when the financiers, because once they look at it favorably, then you can actually put your cheaper cost of debt in. And so Ghana. So you would have seen Tanzania and you would have seen Seychelles. Seychelles from a paradise perspective. We're working with one of the hospitality groups in Mauritius. They've got a footprint in Seychelles. Tanzania is a very exciting country. We just can't get our minds around the tax. There's approximately a 3% tax leakage coming out of a real estate transaction, which means that we have to be buying at 11% property yields to achieve our return back in Mauritius. And VAT is a nightmare there. So the VAT legislation is very challenging. Let me try and use a diplomatic word. And the problem is that you don't get your VAT back. So you have to earn it back over a period of time. With larger deals, it becomes a huge cash flow issue. So what we also want to focus on, the IP that we've built in these countries. We have got a large team in Mozambique now. We've got a large team in Morocco. We've got a large team in Mauritius. We've got a large team in Zambia with our partner, Stephen Herring. And we now want to actually take that IP, and we've built up a very large cost base. It's now sweating that cost base.
I've always known the grid team as a no barrier grid team. And my question is just to ask, are there any plans of approaching established stock exchanges like the US and the UK for grid?
Very, very good question. I think, again, so we need to understand where our stock is best positioned. I think that's been a big deliberation. So we're not a REIT. We benchmark to SA REITs. It becomes very tricky when we benchmark to SA REITs. And we ultimately have to find our home where frontier emerging is the most recognized. So what does that mean? It means that we need to look at both exchanges, both the JSE and the SEM, and we need to look at where frontier is going to be the most driven. But it has to be at the right market cap. Because the worst thing you can do is get into these big exchanges, the LSE, wherever else, and you're sitting at a market cap where you're not even tracked. Because that's when you have a huge challenge. So we are seriously looking at London. It is one of the markets where there's not a lot of Africa exposure. There are currently 5 other Africa stocks, no other real estate. Unfortunately, Atlas Mara hasn't had the easiest time in London, but that's also other fundamentals. But we believe that the largest frontier emerging market tracker guys are sitting in the UK. We've spent a lot of time with these guys. And that's where we believe that we're going to get the most liquidity in that re-rating of the share price. But it's not before June 2018, I can assure you. So we need to do a lot more work. The ideal market cap size, we believe, is $550 million. We currently sit at just over $300 million, so there's still a bit of work to do from a size perspective. Any other questions? Thank you, everybody. So my management team is here today. Leon, Greg, you obviously know. We've got Kai, Karen, Luke, Heidi. So please accost them if you need to. They're all available to answer any questions. And we are seeing some of you one-on-one, so you might keep your questions for there. But thank you very much for coming to the presentation. We know your time is valuable, so we appreciate the time this morning. Thank you.